Yeah, I mean, us as a lender, we really want we want our borrowers to be successful.
You know, millennials and younger are the laziest population that the U.S. has ever seen.
I probably would not be in that location. That probably isn't where Suzanne is going to live,
so. All right, welcome back to your favorite podcast on the planet, Realty Talk Podcast. We have a very exciting episode ahead of ourselves. Today, I will do some quick announcements.
Yes,
first. So we've got, to my left, the queen of the closing table, Suzanne, the founder of Innovate Realty. To my right, we are very excited today to have Mr. Stephen Couig. We call you the king of lending.
Ooh,
the king of lending, founder, CEO of Center Street Lending. And I am your host for the day, moderator with the most. My new nickname on the podcast is Paul Fix It All.
Mm-hmm. Yes.
I don't know if I like
that.
it.
I like it. I think it's.
Who gave that to you?
That would be me.
Nice.
We went like 20 episodes without him having a nickname, so felt like it was time. And that one feels right.
The only reason I struggle with it, which I've mentioned before on previous episodes, is I read at least twice a week this Peppa Pig book to my daughters, and there's like a full chapter, 5 minutes long, of Daddy Pig Can Fix It. And I told the girls that was my new nickname at the office, and they thought it was super funny. So they ask to read the book more now, which is...
I would also call that a win. That's great.
More kid time.
Very wholesome.
I'm ready for that book to go away.
We need to challenge him on what he can fix.
Yeah, someday.
Oh, no, that sounds... Yes.
I think we've already done that, you know?
Yes.
We challenge you on things you can fix almost every day, so...
Yeah.
Well,
let's dive right in. So we've got a little bit of a different episode today. It's going to be more of an interview. So typically we jump right into market updates, what's happening at Innovate, at Buy House, the broader market as a whole in the U.S. And then we do focus a lot in Southern California. I think most of our listeners at the moment are California agents and buyers or sellers. We do get some interesting feedback from listeners all over the U.S. So, but this will be a fun episode just to get some color on, the business that you founded, and so we've got just a couple basic questions.
And I would say for any of our listeners that haven't listened to our first few episodes, so that they have a good understanding, maybe go back and take a listen, because we did dive in pretty deep on that side of the business as well. So
yeah, we talked about background and everything. So we're going to skip over some of that and dive straight in. So Center Street Lending was founded in 2009. Correct?
Yeah, we did the first loan in January 21st, 2010.
Wow, okay. So...
early days.
Yes. So share with us kind of the origin story and the name and how you came to think, okay, I'm gonna go into this industry and I'm gonna name it Center Street Lending.
Yeah, so the name... there's no rhyme or reason for it other than it seemed like a pretty good name that you can attach to lots of different things, and there's a Center Street everywhere. So, I spent probably 6 months thinking about different names, and a lot of them were already taken as far as URLs, and so came across, I was like, oh, Center Street, that'd be pretty good, and it was available, and so we,
so here we are.
Yeah. So 15 years later.
Yeah.
6 months, that's pretty good. I mean, we have made name decisions in like a week over here, so.
You know what? I haven't talked about this on the podcast, but I'm fairly certain a bunch of tech CEOs name their companies out of Dr. Seuss books. Because Zillow is a weird random name in the real estate industry, and it's in the Dr. Seuss book that was published in like the 50s. So they must have seen that word and said, oh, it's kind of a funny, silly word, and then they named it that way.
Yeah.
There's two other examples.
There's a story behind why they named it Zillow, but it could all be false.
Yeah, it was a late night of drinking. He went home and read his daughter a book, and Zillow was in the book.
Yeah,
and that's
the word.
I'm convinced.
Yeah.
Okay. That is great. I want to come back to the naming, but I think it's this next question is worth getting out first. So how has Center Street Lending evolved over the years? I mean, It's been a long time. You've gone through kind of market turbulence.
Yeah. So, I mean, there's been lots of changes in the marketplace. So when we first started, pretty much most of the transactions that we were financing were foreclosure sales. And so in different states have different rules. Some you need to have good funds that day. Some you can do good funds following the actual auctions. And so, it was a pretty involved process with the people that were doing the bidding. So, really the opportunities originally, call it in 2010, a lot of them were at the properties that were being foreclosed on. That pivoted relatively quickly to short sales and, banks, trying to find other avenues to go move the, product that they had. And, probably by 2011 or so, most of the transactions were conventional purchase transactions from a bank or a short sale.
So back then, post 2008, 2009, I wasn't in the industry, but I kind of was tangentially around it. And there were like lending shops that would set up folding tables at the courthouse steps to like verify funds and do stuff. So was that part of the business model?
Yeah, we had a couple of people that would bring cashier's checks for specific borrowers. We had one wholesaler that was buying properties and then reselling them. So we actually started with them at the foreclosure sales and then expanded to some other people.
So and then in post 2009, you also had to have, because when in the lending business, you're giving someone capital, which is kind of an easy thing to do, right? But what's hard to do is get it back.
Yes.
And so
still hard.
Did you have a lot of confidence coming out of the correction that you were starting to lend at the right time and that you'd have some runway, or were you worried about any additional market issues or? Yeah,
the discounts, given the amount of volume that people were having to move and the fact that lots of people had financial difficulties and hadn't gotten back on their feet. There was a lot of product to be sold and to be financed. So,
Yeah, and we'll dig into the kind of structure of a loan, on this next question. But that also probably helps a lot too because of your basis.
The basis back then in call it 2010, 11, you were actually able to go buy houses at less than the sticks and bricks cost to build the houses.
Wow.
Yeah, that's crazy.
So as far as our basis and the loans, you felt pretty safe. You knew you were going to get your money out. You just didn't know if it was going to be 6 months or 6 years.
It's kind of similar to today's market. I mean, it's just a little different, right? But values are on the opposite end of the spectrum. But the costs to go and replace are higher in some markets than what your basis would be. Yeah,
I mean, real estate at the end of the day is a local business driven by supply and demand. And, ultimately there's obviously, depending upon the markets, a greater influence of the cost of financing. In California, a lot of people are all cash. So, that's a little bit less important. It's really more primarily location and condition of the property. In other markets where people are catering more to entry-level buyers or kind of first-time move-up, the cost of financing for those end buyers is obviously more important.
Yeah. So evolution. This is going backwards here. Center Street lending. We hear the terminology around the office as CSL, right? Mm-hmm. It is very similar to YSL, which is a luxury brand. I have a concept that I've been thinking about. I've read a lot about how younger generations value their income less than they value the brand of where they work. Mm-hmm. I think we have to create like a cursive CSL shirt.
That'd be great.
And top producers get an opportunity to win that. But it's like a luxury swag item.
Nice.
Yeah.
Okay.
If that happens, I get credit for that one.
Yeah.
Okay.
Our borrowers tend to care about their pricing then.
Yes, that's right. Yeah, the interest rate. Yeah.
They don't want the shirt.
Well, that's a good segue. So walk us through what a typical loan looks like. Because in fairness, a lot of our listeners are agents that maybe have represented a fix and flip investor, or are agents that want to go and do it, or maybe listeners that like what Buy House is up to and want to go and break into the fix and flip world. What does a typical loan today look like for somebody that wants to buy a house, fix it up, and sell it?
Yeah, I mean, it really depends on the market. So a deal in Florida, those tend to be lower price points versus California.
Yep.
Texas is similar to Florida. Those are our three biggest markets. We do lend in 40 states, so you see all kinds of projects. So our product offering also includes ground up. So we do about a third of our loans are ground up construction, which may be somebody starting from a piece of dirt or somebody buying an existing property, scraping it, and building either multiple units or a larger SFR.
Yep.
So it's a little bit hard to
Yeah, let's talk fix flip.
Yeah.
Like it starts with an application.
Sure.
What are the terms kind of
Yeah,
look
the
like?
loan process. So, the things that we look for from an underwriting standpoint are first and foremost is the project and the viability of the project. So we look at what we think the costs are going to be to go and rehab it, and those things tend to be somewhat standardized on a per foot basis. For what you're doing. So we look at that, and if it's a good project, then we continue to dig in. So majority of our business is repeat borrowers. We obviously do like to do business with people that have done it before because there is a pretty steep learning curve on your first, call it 1 or 2 or 3 deals. And things don't always go according to plan. So we do look at experience. We do look at FICO pretty heavily as well. People with low credit scores tend not to pay on time, and that's a bad thing if you're
or pay
a
you
lender.
back ever.
So that certainly is a factor. And then the last leg on the stool is really liquidity, and does the borrower have enough cash, their own cash, or with partners to be able to go complete the project and to have some reserves to take care of things that. If the project takes an extra 6 months to go and sell, do they have the liquidity to go and continue to make the payments?
So if I'm a listener and I want to go and do my first or fifth, fix and flip transaction, and I'm going to Center Street, what does a timeline typically look like from when I submit my application to when I could actually purchase a property, whether it's on market or off market?
Yeah, I mean, we can move pretty quickly. So, typically we're waiting for title to get us information, and then one of the other things that we require is a borrower to have insurance. That tends to be something where the borrower has to provide that, so they're dealing with a third party, so sometimes those get delayed. But in general, our average time to fund is somewhere less than 30 days.
Wow.
But we can do a loan in 7 days. I mean, we've done them in 24 hours for repeat borrowers if they have everything there. So it's
Just
really
quick as cash.
Exactly. So it's really not how long does it take us. It's really how long does it take the borrower and for us to be able to get the information from third parties. And so it's typically the borrower is going to be closing in 30 days anyways, so that's fine. We can pretty much meet any closing deadline. It's really just a matter of getting the third parties to get the information as quickly as possible. So, in general, if somebody's got a property, they're a repeat, I mean, it could be 5 days.
So, and then on the terms, like let's say it is somebody's first fix and flip investment. I think, a lot of our listeners here, because they transact on traditional deals, they think 30 days is fast because they're looking at debt to income. And if it's a rental property, an investment property, they might be getting 60 or 70% leverage. So it sounds like it could be as fast as 10 to 14 days if everything's buttoned up, maybe 20 days if there's some strain with these third-party relationships. But what does leverage and pricing look like versus 30-year fixed mortgage? Because I think that is a misconception. We talk to agents all the time that look at the volume we're doing and they still don't understand the private lending industry. They say, well, how do you go so fast on a loan if you are still using a loan? Like, doesn't it take Bank of America 30 days to underwrite you? And we're like, well, no, we're not going to Bank of America, right? But what is that just broadly? I know, not our listeners, you can't hold him to a number that he says. But.
Or can you? We'll see.
Yeah, I mean, I guess to one part of your comment, we're essentially like a bank in that, but we're not a bank. So we have large capital partners. We've got our own capital as well, and so really in starting the business back in 2010, there was no institutions that were focused on this space, and it really, there weren't a whole lot until probably 2014, 15 either. So from that standpoint, the industry has matured where you have companies like us that are doing multiple billions of dollars of new loans each and every year. The reason why it's so fast is we only provide business loans. We don't do consumer loans. So from a federal standpoint, we're not subject to TILA or RESPA, and so those are the things that add a lot of time to actually closing loans. There are different states that require you to be licensed, but you're still not subject to TILA or RESPA, so you can still move as quickly as you need to move.
Cool. So in your view, we'll do one more question and then we're going to break for a segment. In your view, what are the biggest trends that you see shaping the fix and flip industry? Not necessarily the lending industry, but just fix and flip as a whole in the U.S.?
I've heard since 2010 that there's no good deals out there. And roughly, in the country, there's probably, call it 200,000 to 300,000 properties that are getting flipped every year. The U.S. housing stock is getting older, so the average age is 40 years now. And, I think it's a great industry because typically people are buying either, functionally or conditionally obsolete houses, and they're making them like new houses in infill locations. The one trend versus early days, that was a lot of the, sort of late vintage houses that had just been sold. Those were the first ones to get foreclosed on. And there it was, the repairs were paint and carpet, right? So those were the houses back on the market in 15 days or 30 days. Now people are changing up kitchens, bathrooms, fixing roofs if need be, doing landscaping and, kind of everything in between, right?
So before 2008, 2009, there's this like glut of new inventory. People stepped up, paid a lot of money. Then the market corrects. So they're 3 to 5 year old houses getting short sold, foreclosed on. Those are paint, carpet, quick turns. That's no longer really there.
Correct. Yeah. I mean, for new sales, new homes being produced back in, call it 2005 and 6, it was probably about 1.4 million units a year. For several years, and today, builders are building about 650,000 new units. So you got 15 years later, we have a bigger population, and we're building half as many homes, which is part of the reason why prices are up, and it's really what creates opportunities for people to be able to go buy stuff that isn't really desirable for an end consumer now. They can go buy it, fix it up, make it nice, and it's attractive because it's a great location. Versus new home construction tends to be on the outskirts where there's land available.
I mean that's the whole thesis of buy house too. I mean you've got boomers exiting workforce. Those are the houses that are 40 years old. Structurally, a lot of times they're maintained properly, but cosmetically they're just not what's going to sell for top dollar today. And millennials and younger are the laziest population that the U.S. has ever seen. So they're not really interested in buying that old, kind of poopy house and then slowly fixing it up in those great locations. But they're also not interested in buying that new track home an hour and a half away from their job. So that's why, at least from our perspective, you see lower, home ownership rates, with younger generations. But the vast majority of the projects that we take off or, to market once we're done renovating are trading to young families.
And I think that's the misconception, and you touched on it a little bit. a lot of times, when someone, I think in the past, it was more of just a cosmetic, quick turn, where now, there's a lot of work that goes into all of these transactions, all of these projects. It's sometimes months, sometimes years, not.
Yeah, those
we don't want those.
Hopefully not years.
But also, you're providing a product that is actually functional as well. It's not just cosmetic. Like there are sometimes where you have to dig in a little deeper. So, and that is really what we're seeing from the consumer. We get these repair requests that, they want a perfect home. So, what's being provided is a little different than what it was in the past.
Yeah.
And what people think when they think, oh, he just came in and, painted the walls and made it look good, lipstick on a pig. We always hear that, but actually that's not the case. That's not what's moving. So.
Yes. Okay. Let's break and do our segment.
Yeah.
So this is a fun segment. It's newer, but it's called Homes Gone Wild. And one of our listeners will submit a story. I have not seen the story. They like me to read it because I guess my reactions are kind of funny. But we're going to read it quick and we'll have a little commentary around it. So this week on Homes Gone Wild, I was doing a showing on a particular house. This was the second time that I had brought my buyers there. It was beautiful. Nice updates, big fireplace in the living room, nice winding deck out back. Backyard slope down the river, just a magical house. Okay, so this is like a mountain house.
Yeah.
Okay. On the second visit, my buyers decided to bring a contractor with them. They were thinking it would be a better idea to get a second opinion on remodeling and the price before they actually bought the house. That is a really good idea.
Yeah, we're just talking about that.
The contractor decided to check the entire house from top to bottom. He went into the basement, around the crawl space, checked out the garage and the wiring, the flooring, and everything else. He had to go to his truck to get a ladder so that he could get into the attic access off the second floor. When he returned with a ladder, he climbed into the attic, and after about 2 seconds, he squealed and then started laughing. My buyers were a young couple, asked him what was so funny. He said, "There's something up there that you should probably see." And then he dropped a snake skin through the hole for us to see. It was a 4 foot long, and according to the contractor, there were about 40 more just like that in the attic. The most difficult thing to figure out was where was the snake that had made them. He couldn't find it anywhere.
No.
I stood there and laughed with him and the buyer's husband, as such things have never bothered me. His wife literally ran screaming from the house. She did this weird little dance out in the front yard like she was covered in spider webs and decided that at that moment that she would never own that house, no matter what.
Yeah, I don't think I would own that house. I don't know. That one, it would haunt me in my sleep for sure.
I mean, yeah.
I know.
To me, I'm like,
you
okay.
love it, but
I don't really like snakes. But to me, it's like, okay, you're buying we're making assumptions. So this is my biggest.
Snake could come back.
It could come back. That's its home.
It probably will because you're buying a house by the river.
In the mountains. I probably would not be in that location. That probably isn't where Suzanne is going to live. So
what I like about Homes Gone Wild is we get really interesting things like this. What I hate about it is like, did the house sell?
We need more.
Where did these people buy? Did they decide to not buy near a river? Like, what ended up happening with this one?
Yeah, I guess if that is your market and that's where you're looking, you have to know what's going to come along with that. Unless, I don't know, they're probably watching TV and movies of they said magical. It's a magical house. Maybe didn't think that one through.
Okay. All right, back into it. We have a few more questions, and then we're going to break. So what common pitfalls do you see a fix and flip investor make? Like, what are the challenges that you see most often when somebody has a problem on a...
I think everybody, it's relatively easy to figure out what something should sell for once you go and fix it up, and obviously you know what your purchase price is. So I think the biggest pitfalls that we see are people underestimating either the time or the cost to go and improve the property. So, generally, again, it's depending on market and the level of upgrade you're going to be doing, but people typically are spending somewhere from $50 a foot in sort of lower price markets to $150 a foot for basic but extensive rehabs in California. So, when we're looking at deals, we actually have people review the budgets, and we look at the appraisal as well to see the condition of the house. And, you can use those rules of thumb to make sure that, on a global basis, you kind of have enough dollars to go and fix up what needs to be fixed up.
Yep.
And, unfortunately, if you're doing a rehab, and sometimes ground up construction is easier because you're just starting with a piece of dirt.
Yeah.
So you know what you're building.
There's no surprises.
Yeah.
Correct. And, if you're buying an existing property, sometimes you think you can take out a wall and you find out it's a load-bearing wall and you can't take that out. So then you're putting in beams to provide the space. And so things can add up pretty quickly. The other thing is I don't think spend enough time vetting the contractors that they're using or the GC.
Yeah.
Because if you have a GC that's not doing their job, they're costing you more absolute dollars and they're costing you a lot of time.
Yep.
And this business it's just like the home building business where margins are single digits on revenue.
Yeah.
They're really attractive on return on equity because you get leverage with it. But you have a relatively skinny margin, so you have to get the project done on budget, on time, and get it sold on time to be hitting your numbers, right? Especially in a market like this where prices aren't really increasing, it may be kind of flat to even maybe down a little bit.
Yep.
You don't have the luxury of home price appreciation over your hold time, which generally will increase the house price by 1 or 2%.
Yeah.
Over 6 months, and 4 or 5 over a year.
Yeah, I mean that one's really important to, I think, double click on because you brought up some different points. The profile of a borrower that's getting underwriting a deal and thinking, okay, single digit returns like 8, 9, 10% maybe they're looking at a 10% deal. When we say return on revenue, we're thinking, okay, if you're selling a $1 million house and you get a 10% deal, you're going to make $100,000 after everything's said and done. If you hire the wrong contractor, or in that beam situation, let's say you plan to open a kitchen, you think it's not load bearing, your inspector's likely not going to be able to tell unless they really shake the house down. Mm-hmm. And most inspectors won't give you that opinion, so they're going to have you bring in like an architect or an engineer to tell you for sure if it's load bearing. But if you make that mistake, I mean, that could cost you 3 months, if not more, depending on the city that you're in Southern California, because that's going to require a set of plans. You got to go to the city and get the permit. That might even require doing concrete work underneath the house to secure the beam that you're putting in. So it's not necessarily just the cost, it's really the time. And if let's say that I was a repeat borrower, is it safe to say I could get like 80% leverage on my purchase in a fix and flip world? Yeah,
so in general, repeat borrowers now are getting, and it depends, there's repeat for one and there's repeat for people who have done 10 projects. So generally we look at the history over the last 3 years for what the customer has done. For our better customers, when we're giving 90% of the purchase and 100% of the rehab, and if they're super good, like even a little bit more than that on the purchase.
Yep.
So if you're if this is your first deal, we're probably going to be at like 85% total costs. So we would hold back the amount for the rehab, and then you would get the difference up front.
Yep.
So generally, that's going to be like 82 or 83%. Up front, and then 100% of your rehab dollars.
So, but just to kind of create the picture for our listeners, if you're thinking of doing your first fix and flip transaction, and let's just use that example of the home is going to be worth $1 million once you fix it up. Let's assume that your rehab is going to be $150,000. Mm-hmm. So you're going to have transaction costs on both sides of the deal. So if you're trying to net a 10% deal where you make $100K, you're probably buying somewhere in the mid to high sixes. In that environment, and so you're coming down with, let's say, 20% of that $600,000 purchase price, roughly, maybe a little higher depending on the person. But my point in bringing that up is you might bring $120,000 down to get into the transaction. You're going to carry your interest payments, but if that 6-month deal takes 9 months or 12 months, then your return on equity, unless you get lucky and the market goes bananas, is just dwindling every month, right? So you still may be profitable and you still might make money on that single transaction. But if you were to think about this as a model where you want to go and do this at scale, it's almost more important to finish the project on that 6-month window, even if your total margin is lower, because you put the capital back to work and go into another deal. I don't know that most fix and flip investors think that way. I mean, I talk to a lot, and they look at, well, I made 50 grand on the deal. It was great. It's like, well, you would have been better off making 40 in 6 months than 50 in 9 months, and then going into another transaction. So, and what I would say for our listeners is go back, I think 2 episodes. We walked through, kind of common pitfalls when somebody's looking at buying a house, the things that they could be doing to eliminate some of those challenges. Things like hiring great inspectors for termite work, for sewer work, for roofs. Obviously, a full home inspection. Sometimes if it's hillside soils inspections, right? All those little things ahead of the purchase will save you a massive headache, once you're in it. So,
well, and I think it's a unique perspective because we have, buy house, but we also have Center Street Lending where, there's so much insight. You see so many deals, and so even to your borrowers, I think that provides so much value to them. As you were saying, you're kind of reviewing their budget and making sure that it's, in line with what the actuality is, where not everyone has that expertise. You see so many transactions and you have so much data that you can really pass that on to your borrowers as a value as well.
Yeah, I mean, us as a lender, we really want we want our borrowers to be successful. And so, if somebody hasn't done a lot of properties, we'll look at it more closely and make sure that, again, we think it's a viable project. And, if somebody's got 10 properties under their belt, then we're treating them as they know what they're doing. Right. And so our review is much less on that. But, the worst thing that can happen is you get, it's easy for us to go give a loan, but if the person's not going to be successful, we don't really want to be involved with it because it's just bad business. And we'll try and talk people out of deals that they're doing if we think they're paying too much. And, oftentimes they'll go get price reductions.
Yeah.
And it turns into a good deal.
Right.
Yeah.
and so.
Yeah.
Okay, we're short on time. I've got just a couple more basic questions. So, the economic cycle that we're in at the moment, how does inflation and interest rates affect the world of lending today?
Yeah, I mean, inflation for asset values tends to be a positive, right? Yep. So if things are going up, then you can go and sell them for more, and it sort of masks any mistakes that you may have had over the life of your project. And interest rates, higher rates mean, it's more expensive for people to buy houses if they're using financing, which most people do.
Yep.
And so that obviously makes the potential pool of buyers less, or being able to pay less because their monthly payments are higher. And so, I personally prefer markets where prices are steady and they're going up by a moderate amount, which is normal. Typically, if you look, over the history, home prices, and I haven't looked at this recently, but home prices historically went up by about 1% more than inflation, over the, over the course of, last 40 or 50 years.
Yep.
But if things are going up dramatically, then sellers want more, and that tends to just tends to put in a lot more uncertainty into your projects. And so we prefer sort of flat, modest growth markets, and let people actually function without these external factors that they have no control over, really affecting the success of their project.
Volatility bad, speed good.
Yes.
Okay. So thinking back from the day you started the business until today, can you share with us a success story? Obviously, no names, of a borrower that you were just like super pumped to be involved with. Like, think of a borrower that,
A happy ending?
Yeah, just a great story,
well.
a success story.
Yeah, I mean, listen, the vast majority of our borrowers are successful. They're doing this for a living.
Yeah.
And so, they're doing it over and over again. We've done, I think, 9,000 loans at this point in time. So I can't pick one success story, but it is great to see. New construction is very exciting because you're seeing a new house being built, and we'll do multi-million-dollar loans. So you can see some pretty nice houses being built. And it's great to go and see that, but it's equally rewarding to see somebody that took. There's nothing better than looking at appraisal pictures and there's pink bathtubs and like green sinks and stuff that's just really old and ugly. And it gets turned into like a really cool new house in a great location. And that's, to me, that's actually more satisfying to watch those success stories. And listen, if people deliver a good product, if they've stayed on budget relatively and stayed on timelines relatively, they're going to make money doing it.
I thought you were for sure going to say bye-bye house. I don't know. I did.
We've had our fair share of wins.
We love all of our borrowers equally. Except the ones that don't pay us on time.
We've never done that. We've always paid on time.
There you go.
The only thing I would say about pink bathrooms is that if you're an agent in Palm Springs, we have nothing against colorful bathrooms and mid-century deals.
There's no carpet in there. That's where we got to draw the line.
Carpet in bathrooms
that's pretty gross.
That's a rough one. Rough one to see.
Okay, last question. Looking ahead 5, 10, 20 years, what does Center Street look like? What do you think changes, or is it more of the same stuff? Do you see anything exciting, or any risks or any challenges? What do you think of the future for Center Street?
Yeah, I mean, it's really, our future is the opportunities that the housing market will go and create, right? So our goal is to provide attractive loans from a structure standpoint and a pricing standpoint to our borrowers, and to be able to offer a loan for every good property that we see and good borrower that we see. So our industry has tended to focus on 1 to 4 unit properties. Those are the most liquid in the marketplace. But we'll probably continue, as we continue to grow, we'll probably start doing larger projects, which will be multi-family properties, either for rent or for sale. So we've done loans as high as $40 million, but our average loan's $1 million. Is $1 million. So we'll probably end up doing more larger loans where there's multiple units involved. If somebody's buying an infill property and it's got excess acreage on it, and they're going to go subdivide the land and go build multiple properties, we really like those investments because, again, you're delivering now new product in an infill location. So we'll focus on those, and we'll continue to focus on providing loans across the country to good borrowers also. So if it's a $200,000 loan and pick any state, that's
Des Moines, Iowa.
That's fine. I don't know if we've done loans in Iowa, but sure. Up to a $20 or $30 million loan for somebody building out a small subdivision.
Awesome. So lots of optimism in the market and the business as a whole.
There's more people, being created, although I'm not sure this year with everybody leaving. But there's more. The U.S. population is growing, and the supply of housing is grossly below what is needed. I don't see that changing, just given the rules and regulations in most states to actually go put out new product. So I think there's a good foundation for house prices on a long-term basis, which is healthy. It would be nice if affordability was a little bit better. So that can happen a couple of ways. Rates can come down, which long rates are probably not going to come down until the budget deficit gets basically figured out. But as incomes continue to grow, people can afford more. So over time, the markets tend to kind of self-correct themselves.
Yeah. Very good. Well, we get a lot of different types of listeners. So, what I would say is if you're on a college campus listening to this, or if you're new in the real estate industry as an agent, and interested in checking other things out, go check out Center Street Lending online. They're hiring. There's always opportunity there. Obviously, Innovate is always bringing new agents on. We've got some exciting new news in the future related to growth. So,
for agents that are out there, the one thing that's a misconception is we can actually pay broker fees because we're doing business loans, and so on conventional loans, you're not able to go and do that. So if somebody has a good borrower with a good property, they can actually get paid. There's markets where you need to be licensed, and so they would need to be licensed in those states, but it's a select number of states. In markets where there's no licensing required, then we can pay them as well.
Yeah, I think that's something that we remind our agents of, but probably not enough, because it is it's just so rare that agents wouldn't even think that they can get paid off of these types of loans, or loans in general. So that's a huge point. All agents work with investors. So whether, what we come across a lot is an agent that is wanting to get into the business themselves. They've been working with investors. They see, or they think their investor's job is super easy and they want to start making money. So whether that's the case, whether they want to go that route, or those investors that they're working with, they want to bring them to Center Street Lending, regardless, they can get involved. So I think that's really huge, and more agents need to know that that's a possibility.
Yep.
Yes. All right, very exciting. Anything else that either of you want to add before we close this baby out?
No, I learned a lot. Thank you.
Me too.
All right,
No
if
snakes.
you haven't done it, please hit the subscribe button. Check us out on all the platforms. We appreciate our listeners. It gives us the opportunity to go and do this. That is another Realty Talk podcast in the books. We will see you next week.
See ya.